Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks declining for a second day as a record-breaking rally loses steam. Treasuries holding gains on mixed U.S. economic data. Citi Research Head of Emerging Markets Asia Strategy, Rohit Garg, will be joining us in just a moment with his outlook for markets this year. The U.S. announcing plans to control future sales of Venezuelan oil as it tightens an energy quarantine, seizing more sanctioned tankers. The raid on Caracas marks the debut of Trump's so-called Donroe Doctrine, believed to be aimed at restricting China's clout in Latin America. We'll assess the implications. And India expects GDP growth of over 7% this year, keeping its crown as the fastest growing major economy. We'll discuss what's driving the optimism despite trade tensions with the U.S. Asian markets facing geopolitical headwinds as tensions between Japan and China ramp up ahead of key U.S. economic data. China has launched an anti-dumping investigation into a crucial chip-making material from Japan, marking a fresh escalation in their diplomatic standoff. The move comes a day after Tokyo criticized Beijing for introducing new export restrictions. And traders are watching Greenland's future after the Trump administration called the island vital to U.S. security. Washington's ousting of Venezuela's Nicolas Maduro has reignited Danish concerns, with Prime Minister Mette Frederiksen warning that a U.S. takeover of Greenland could spell the end of NATO. Now, looking at shares in Samsung, its fourth quarter profits soared by more than 200% as surging global demand for AI servers drives up memory chip prices. Let's bring in Bloomberg Intelligence senior analyst Masahiro Wakasugi. Masahiro, how do you read the preliminary results for Samsung?
Hello. Yes, if we look at the Samsung's operating profit, it was pretty strong, and 20 trillion won was quite a strong number. And probably a few weeks ago, Micron reported very strong numbers, so some people already expected a strong result from Samsung as well. But I think that if we look into the details, the company did not announce any breakdown, but we can roughly calculate maybe the semiconductor division operating profit margin. The operating profit margin for the overall Samsung should be around 21.5% in Q4, but probably the Samsung semiconductor division operating margin should be around 35 or 36%, which is quite high, and maybe DRAM segment operating margin exceeded 50%. So I think that we think that the Samsung earnings was quite strong, and which should be sustainable going forward.
When you take a look at the reaction in the market, it was negative initially after the results. Are there concerns on Samsung's business outlook?
Maybe regarding the concerns, maybe of course if we see the weakness in the capex by the AI hyperscalers or AI neo cloud, that would be the risk. But we don't see a sign of the weakness, and probably if we look at their sustainability of the memory chip business, we think that the memory demand should be entering the structural growth phase, meaning that probably the sustainability should be fine. And let's take an example of the large language model such as ChatGPT. The more we use, the more data the model has to remember. And we input a question, and the LLM answers and return some output. And if we continue, the model has to remember all the conversation we have. So in that sense, the more we use the ChatGPT, DYLM, the more data they have to store. And now the number of users are increasing all over the world, which is a bit different from the AI training. So I think that going forward, the demand for the memory chips, including DRAM, HBM, and also non-flash memory will increase going forward.
Masahiro, thank you so much for that. Bloomberg Intelligence Senior Industry Analyst Masahiro Wakasugi. Let's go deeper on the AI narrative and how it's impacting markets. Rohit Garg is head of EM Asia Strategy at Citi Research. Rohit, good to have you with us. We've heard about how Samsung got a lift from the AI play. I mean, when you take a look at EMs as well, they've been lifted by AI and tech. How much momentum is there?
At this point of time, we continue to be quite bullish, in general, sort of the core AI beneficiary countries, for instance, Korea and Taiwan. In fact, more recently, we've gone overweight both Korean equities as well as Taiwanese equities and underweight Chinese equities, pure as a relative value trade. It's not necessarily that we are bearish on Chinese equity. We're still bullish on Chinese equities. It's just that when you compare the relativeness, we actually think that Korean and Taiwan equities have a lot more room to sort of outperform. So I think we believe that there's still momentum into this.
But some say there's so much potential for Chinese AI plays. I mean, valuations are not looking too expensive, and they have a long way to go.
Yeah, no, but I mean that's why I say that it's purely on a relative basis, where we actually think that there's probably more room for Korean and Taiwanese equities to actually perform. But yes, in general, we think that all the countries that are benefiting out of this AI theme, Korea, Taiwan, China, Singapore, Malaysia, they're all the, depending on which is the core, which is the periphery, but all of these group countries we think will be benefiting in terms of equity re-rating.
We continue to talk about CAPEX, ROI, and of course that bubble in AI potentially bursting. If that were to happen in the US, those in Asia will get hit as well.
Yes, no, that's definitely a big risk right now. That has been a risk for the last 1 month. In fact, there continues to be quite a bit of debate. That's one of the biggest questions that we actually get for investors. But so far, when we actually look at least, the pipeline of export orders, even some of the commentary that actually is coming out of policymakers, for instance, more recently, even Governor Ri of Korea actually mentioned that, even if there were to be a bit of stumbling block in AI, but just the export orders or the order book until Q3 actually looks quite solid.
So it's not just a valuation story, it's also a fundamentals story. Is that correct? So all the stars are aligned.
Definitely, especially in the memory sector, when we actually look at the supply-demand dynamics, look at the DRAM prices, that actually reflects that how much, the demand is actually outweighing the supply at this point of time. We actually think, yes, definitely, there's a bit of a fundamentals push that's actually helping Korean and Taiwan equities.
What is the biggest risk?
I think the biggest risk has to be that, that for some reason that we are not just able to monetize this AI story. That has to be the biggest risk. The other risk is that, again, if the demand continues to be quite solid and that continues to lift up prices, then that is the other end of the risk, that, that at some point of time things actually become just too expensive.
You talked about a distinction between markets exposed to AI and those which are not. Those which are not include the likes of India, for instance. Surely there is reason to believe that there is value in these markets should that AI bubble burst. So how do you position in such an environment?
No, that's a very good point, I have to say. You go back about 12 months or 18 months, India was one of the darlings as far as equity markets were concerned. And one of the big reasons why India was a darling was because of the domestic consumption narrative that was shaping up Indian equities, and of course the lack of investment opportunities elsewhere. Now, of course, AI has become such a dominant theme. Of course, India has also got, entangled into various trade issues. So due to that, Indian equities have taken a bit of a back seat. But I have to say that, yes, as a bit of a hedge to the AI theme, Indian equities can always come back. In fact, I have to say valuations have cheapened up now for Indian equities as compared to the rest of EM.
So how should your allocation be in your portfolio?
Well, right now at this moment, we are still very much, gearing towards the AI theme. So from that perspective, again, overweight Korean and Taiwan equities versus Chinese equities is what we are looking at EM Asia, at least for this moment.
Some people are looking at Vietnam. It is on the verge, on the cusp of being included in the major indexes. Could that change the picture somewhat?
It could. But again, you want to be still in the countries where you actually have liquidity, which are the direct beneficiaries. The only issue that we actually have is, again, when we think from a macro perspective, again, zooming out a little bit, I think one of the biggest risks that we have to think about in 2026 is that so far, the trade-related disruptions have only been fading away. But what if, for whatever reason, it actually comes back? We still haven't really spoken about the transshipment levies that people were talking about last year. What if it were to come back? Because, again, when you actually look at Vietnam, I think that's been one of the biggest beneficiaries in terms of being one of the connector countries, right? You look at Vietnam's exports to U.S., they've actually skyrocketed. Vietnam's, again, sort of trade surplus with U.S., that's actually skyrocketed. So that is definitely one of the biggest risks, I have to say.
And the other theme, of course, is still de-dollarization. Despite expectations that the dollar may weaken, the dollar has been pretty resilient where it is right now. That could be a risk for EMs.
At least for now, we were actually thinking, for instance, again, if de-dollarization was a big theme because there were lots of things that were happening.
No longer?
At this point of time, I have to say, at least it has taken a big backseat. It has taken a big backseat for various reasons. I think one of the big reasons as to why people were trying to sort of de-dollarize, apart from various political reasons, geopolitical reasons as well, was just the fact that they were increasingly getting worried about U.S. fiscal dynamics in itself. But since then, U.S. has actually pulled away quite a bit. We are now talking about, for instance, 10-year being around 4%. In fact, our own official forecast for U.S. Treasuries is 3.75. So purely from looking from that angle, all the reasons that we were actually thinking as to why we might need to diversify away from the dollar, that has taken a bit of a backseat. That doesn't necessarily have to say that from a structural aspect that's not going to be the case. I think from a structural aspect, people in general, reserve managers and others will try to sort of make an attempt to sort of reduce or at least try to find alternative investment avenues. It's just that the pace of de-dollarization has taken a massive hit.
Rohit, hang tight. Rohit Garg of Citi Research is sticking around. Up next, former Fed Vice Chair Lael Brainard gives us her read on the central bank's rate path and the direction of the U.S. economy ahead of a key payrolls print. Keep it here with us. This is Bloomberg. Welcome back to Insight. Former Federal Reserve Vice Chair Lael Brainard thinks the central bank's independence is key to keeping global investors confident in the dollar. She spoke with us earlier and gave her thoughts on the Fed's decision last month to cut rates.
Well, I certainly think that the Federal Reserve made the right call starting in August to focus on the labor market. We saw 5 months in a row the unemployment rate ticking up. The job market had slowed, and also the tariff impact was somewhat more moderate than many had feared. And those things together made sense to do some insurance cuts. They did 3 cuts in a row. But as you know from the minutes and from a lot of the remarks that some of the Reserve Bank presidents in particular have given since then, it was a finely balanced decision. And so I think a large number of the committee are going to want, unless the data really deteriorates dramatically, are going to want to be on hold for at least a meeting, maybe 2 meetings, while they observe how the economy is progressing.
And between inflation in the labor market, and since we're looking at data now, which of the two do you think currently holds more weight as far as decision making is concerned?
I think the labor market is the focal point for the majority on the FOMC. Again, the unemployment rate has ticked up. It's now at 4.6%. We'll know more tomorrow when we get that December payrolls number with an unemployment rate, and that is going to be very carefully scrutinized. The last set of data was not very good because of the shutdown. Also, we've had a lot of government workers coming off of government payrolls during this time. So tomorrow's print on unemployment is going to be very carefully scrutinized. I think if you saw a jump up in the unemployment rate, it would put a cut back in play. But so far, we've seen data from ADP and also from job openings, layoffs, that suggest that the labor market continues softening, but is holding.
Can I just ask you a direct question, though? As it pertains to political pressure on the Fed, in your view, do you think the Fed has lost perhaps two things separately, a degree of autonomy, and perhaps because of that, a degree of objectivity as it pertains to decision-making?
Well, I think that is certainly what is at risk here. And I just can't begin to emphasize how important that is. The Federal Reserve's independence is really at the crux of its ability to keep inflation down. It's also at the crux of why global investors are so confident normally holding dollars, because the Fed has a track record of institutional independence, certainly since the 80s, of keeping U.S. inflation low and stable. And that, in turn, means that Treasury securities hold their value, dollars hold their value. So a lot is on the line here. And yes, the president has taken unprecedented measures to put pressure on the Fed, including, for the first time ever, firing or attempting to fire a governor without going through an investigative process. And that's why this Supreme Court case, we'll see hearings on that January 21st, is so crucial. If the Supreme Court doesn't uphold that the Federal Reserve is different from other independent agencies and that you cannot fire governors at will, that would be a major blow to inflation-fighting credibility in the United States.
That was former Federal Reserve Vice Chair and former White House National Economic Council Director Lael Brainard. Let's get insights on the Fed with Rohit Garg, head of EM Asia Strategy at Citi Research, who's still with us. It does seem like the economic data coming out of the U.S. has been so mixed, it's hard to tell the path of the Fed. Some say, you know what, expect 2 rate cuts, but others say it could be 1, and you say it could be 3. Why?
Yeah, so thanks, Haslinda. So yeah, I think from Citi's point of view, we actually think that this year we could actually see U.S. cutting by 75 basis points, and the key thing will really need to be the labor market, as everyone says. To us, the focus will really need to be on the unemployment rate, which has been ticking up, and again, this week's number, more than the headline number for payroll change, what we'll need to see is the unemployment rate. Even if it remains at 4.6, that will actually tell us that the November tick-up was not sort of an anomaly as such. And the fact that in the last many months we've actually gone almost a percentage point higher, that tells us that the labor market's actually softening a lot more than what appears to be on the surface. So that's why we think that 75 basis points are on the cards. We think 50 basis points in Q1 and another 25 in September of this year.
Does 75 take into account the new Fed chair? Does it matter? Might you change your mind about the Fed rate cuts, whoever comes to take over that position?
At this point of time, that's not under consideration right now. I think we are purely looking at the data, we are purely looking at the fundamentals to make our call.
President Trump has said his choice remains intact, remains the same, and some suggest that is Kevin Hassett. Would Kevin Hassett, as Fed chair, change your, expectations of what the Fed does this year?
I mean, that's see, the Fed independence is a question. We keep getting questions around that thing. In fact, I remember even last time you asked me that question. And my reply to that has always been that I think more important than just, the Fed chair is to actually see how the entire FOMC reacts to data. So far, the labor market has actually been softening. The real test will be that if conditions evolve in a way that does not call for Fed to actually cut, and if the Fed still goes ahead and cuts, then that will be a big question mark. So far, that's not really the case. So far, the labor market seems to be softening. Inflation, again, despite everything that's actually happened, has not really ticked up much. So that really basically gives us the confidence that the Fed is really reacting to the data, and that will continue to be the case.
One of the big themes this year is also the divergence in rate path between the Fed and the rest of the world, mainly Asia. How is it influencing and shaping where capital is deployed?
Right. So in Asia, as in 2025, going into the Liberation Day, lots of central banks had cut rates in anticipation of a growth slowdown. And throughout 2025, what we saw was, Asia has been able to weather a lot of the disruption. In fact, if anything, we've actually had tremendous amount of growth upgrades in Q3 and Q4. To the extent now that a lot of Asian countries are now sort of pricing in rate hikes. Even in Korea, for instance, we are pricing in about 50 basis points of rate hike. Similar is the case in Taiwan. And now more recently, we actually now expect even the MAS to now hike in April to increase the senior slope in April. So I think the way that it's sort of manifesting is, of course, a bit of steeper curves across this region because we do see end of easing cycle trades sort of appearing over here. Currencies are a lot more better behaved because on one hand, Fed's actually cutting rates, but on the other hand, we are now pausing in terms of rate cuts in this particular region. Of course, as I mentioned before, equities have been doing quite well, even though one can actually argue that maybe, as much as how we've seen the equity re-rating, we haven't necessarily seen that much of inflows, but still currencies have been a lot more better behaved. So, yeah.
Given expectations of some of those rate hikes in this part of the world, including Korea, might that impact how its stocks perform? I mean, 70-80% increase. It's not realistic this year.
Yeah. So in Korea, we're not really pricing in a rate hike so far. I mean,
it might happen?
At this point of time, unless and until we see again, sort of 2026 GDP numbers go back up by another 0.5%, or even inflation goes to like 2.5%, we think it'll be difficult for the BOK to actually still deliver a rate hike. Korean equities, however, is a different thing. I think right now, again, zooming out a little bit, the way Korea is actually behaving, Korea is a classic case wherein, again, the capex related to the private sector, the AI especially, is coming along at the same time when you actually have public investment and spending going up. Ever since the Lee administration came in, we are actually looking at a much wider fiscal deficit for the next 3 to 4 years. So Korea is a classic reflation, story that's actually shaping up. So even though we may not necessarily see another 70% gains, we are still looking at another 20 to 25% gains for KOSPI for this particular year.
So which are the other outstanding markets for 2026? I mean, China, some say, is going to be quite an outperformer.
I mean, in China, China has been a different story. In 2025, we had a classic K-shaped recovery happening in China, wherein the new economy / AI narrative sort of, really boosted Chinese exports, the competitiveness of Chinese exports, and we're now talking about $1 trillion plus sort of trade surplus for China, right? And that could actually very well continue in the sense that that K-shaped recovery in China could very well continue, wherein, again, exports continue very well. That's where the policy focuses. In fact, the new 5-year plan that's actually come about, that's actually doubling down on the industrial policy in a way, on their innovativeness on the industrial policy. But then, because of that, the domestic economy is taking a bit of a backseat. The domestic economy is not really seeing that same love as what should have really been the case.
The trade surplus, some say, could perhaps, I guess, be a consideration for the PBOC in defending the currency. Your take on that?
So we actually think that, a $1 trillion plus trade surplus, in fact, actually gives the confidence to the policymakers that, we've actually been able to achieve this kind of trade surplus despite the trailer disruptions. So that actually, because it gives a little bit more confidence to policymakers, we actually think, in fact, if anything, this could be a reason to allow some degree of RMB appreciation, and at the same time, use that RMB appreciation to have a bit of a goodwill amongst the trading partners.
Rohit, always good to have you on the show. Rohit Garg, Citi Research. Still to come on Inside, we will have the latest on U.S.-Venezuela tensions and how they're affecting Latin American countries. We'll get analysis from Maria Puerta-Riera of Valencia College. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets stand as mainland Chinese markets head to lunch and Japanese traders return from their break. Benchmarks across the region are struggling to find direction as investors await U.S. jobs data for clarity on the Fed's next move. Meanwhile, geopolitical concerns continue to weigh, with China opening an anti-dumping investigation into Japanese chip-making materials and the latest escalation of the dispute over Taiwan. And Asian defense stocks moving higher after President Trump said he will push for a 50% boost to the U.S. military budget to $1.5 trillion. The sector has been rallying on growing global military tensions after the U.S. captured Venezuelan President Nicolas Maduro and as Trump now sets his eyes on Greenland. And turning to the oil markets, prices are edging higher as Washington says it plans to control future sales of Venezuelan oil and hold the proceeds in U.S. accounts. The statement from Energy Secretary Chris Wright is the clearest signal yet on Washington's strategy to control Venezuela's most valuable resource. Meanwhile, U.S. forces have seized 2 more sanctioned oil tankers as part of their energy quarantine of Venezuela. The move risks inflaming tensions with Russia as one of the ships had switched to a Russian flag. The U.S. intervention in Venezuela is a forceful first demonstration of what Trump has called the Donroe Doctrine. It's his reinterpretation of the 19th century American policy named for President James Monroe, establishing U.S. dominance in the Americas. For more insights on how this affects Latin America, including the influence of rival superpower China, let's bring in Maria Puerta-Riera, political science adjunct professor at Valencia College. Maria, good to have you with us.
Great to be with you, Haslinda.
What do you make of the moves, all the moves to date that the U.S. has done on Venezuela?
I think we're still trying to figure out exactly what the plan is. It started with the anti-drugs operations in the Caribbean and the Pacific. Then it moved to the seizure of oil tankers. And right now, it seems that regime change in Venezuela was not exactly what they were looking for. So it's been overwhelming in terms of trying to get to an analysis that really responds to all the questions. But I guess we don't have the answers right now. What all these moves, like you say, are exactly pointing to, we have some scenarios, not just oil. It could be oil. It could be, as you said, the interest of the U.S. to really exercise control in the region. But some of us also think that it's not necessarily the control that we were used to previously. Before this version, the Trump corollary is really far-reaching. It's oil business, right. It's the minerals. So it's beyond what we were used to.
Some also suggest that it is a way to perhaps put a lid on China's influence and footprint in the region. Talk to us about China's influence in Latin America. Just how significant is it?
It's been very significant, especially, but not limited to, left-leaning governments and regimes, because this has been a very sophisticated approach the Chinese regime has used, applied, and exercised from Cuba, Nicaragua, Venezuela, but also other countries that are not necessarily aligned with the strong left-leaning governments that I mentioned, for example, Chile or Brazil. So this is a problem that the U.S. has been sort of ignoring for a while, regardless, Democrats, Republicans. They've had a problem with China. And right now, the caution on their side is not necessarily because they are afraid of what's happening. I think they are also watching what are their chances to keep I wouldn't say interfering right now is not their intention. They are being cautious, but I don't think they are ready to leave the region.
The question really is, how successful can the U.S. be in peeling Latin American countries away from China? We're talking about, almost $600 billion in trade, $180 billion in FDI. The likes of Colombia, Argentina, Brazil have remained committed to China.
I think the answer or partial answer to that question is exactly what happened with our farmers here in the U.S., the soy, I think it was the soy farmers. They lost with the trade, the tariffs imposed on their side. And who benefited from this? It was Argentina. There was a bailout, right? There was a supporting policy coming from the White House. But instead of benefiting our own farmers, we are getting China additional help. So I think the problem is that when the strategy is not well thought, you're going to see these, and then the government here, the White House, has to scramble to create additional subsidies and programs for these farmers. We're losing in terms of the strategy, but also we're leaving room for our supposed competitors to have it easier.
It does seem like the U.S. is embarking on a more interventionist policy in Latin America. I'm wondering how the leaders in the region are reacting to perhaps the idea or the possibility of extraction as a U.S. policy.
Well, if you read what the corollary really means, is they understand that national security is connected, is closely linked to having not just the capacity, ability to exercise power and control over other countries in the region, but mostly, and that's what we gather from what the president has said lately, between yesterday and today, he has insisted that he wants to control Venezuelan oil. And today, the White House presser was basically, we're going to have all those oil, all the oil income is going to come our way, and we're going to create I don't know legally how that's going to work because that has to go through Congress. It has to be appropriated. But they said that they would find a way with the Treasury Department to directly administer those resources. That's how they conceive this power structure in the region. And I think that is a warning, or should be a warning sign, not just Venezuela's already embarked in that, but for the rest of the region. If you want to do business, this is the heads up you need.
And of course, we've heard from Colombian President Petro. He talked about this verbal crisis with the U.S. How are you interpreting this? I mean, we know that Colombia has been a strategic ally of the U.S.
I think that is the main reason why they had to tone down the rhetoric. Colombia is strategic, regardless of who's in power. Given not just the geopolitical situation, neighboring Venezuela, the drug business, but also the U.S. has invested so much in their anti-drug policy, including Colombia, that it doesn't make sense for this administration to throw away that. It's an asset. But the other reason is that Colombia is going to have presidential elections this year, very soon. So it doesn't really, this is not the time for the White House to pick a fight with a president that is leaving very soon. And he can probably exercise influence in the election just like he did with Honduras.
And of course, it's not just Colombia. We had President Trump singling out Cuba. And of course, we've talked about how Marco Rubio has a project of wanting to reshape Cuba. How do you square all of that? How do you see this playing out?
Well, if you look at the consequences of not just the boat strikes in the Caribbean and the Pacific, plus the oil tanker seizures. One of the most affected by it is not just Venezuela, it's also Cuba. The Cuban economy has taken a hit. They depend on these the oil tankers, because they receive oil from Venezuela and they resell that oil. So that is hitting their finances. They don't use that oil for, electricity, or they resell that oil. And according to what we know from a very critical assessment, is that Cuba is right now in a near economic collapse. So we don't really know if this strategy is not just to break down the regime in Venezuela. It doesn't seem like that's the real end game, but it does look like Cuba is going to have to face consequences, not just because of the economic impact, but also we've learned that the relationship between Rodriguez, the newly sworn president in Venezuela, is having a very difficult relationship with the Cuban regime. So, 2 + 2 might be 4.
There's still a lot of uncertainty, but we do know that the U.S. and Trump continue to exert pressure in the Middle East. To your point, I'm just wondering if you expect more vessels to be seized by the U.S. to put even further pressure.
Well, that's what Vice President Vance said today, that this is not going to end. I'm afraid they will. They see no opposition. They don't see resistance. Let's see what Russia says, because I believe these 2 tankers were using Russian flag. But I don't think they're going to stop. I think they feel emboldened. And based on what the vice president said today, it seems that they're going to continue to do this.
What are you most concerned about? And what do you see happening in the coming days?
I think the situation is still very fluid. We know there is repression in Venezuela. And I don't know if the Trump administration understands the depth of the problem that Venezuela is. Things are not solved just because you decapitated the head of the regime. And by the way, you also decapitated the head of the opposition. So you are leaving the country in a situation that is beyond a turmoil. And we don't have any clarity about elections. Today, Secretary Rubio said that they have a plan and they have several steps or stages, and elections would be the last. That's not something that's going to bring any calm or any confidence among the Venezuelan people. And I think the Trump administration needs to provide a little bit more of clarity about how they're going to achieve peace and a democratic transition in Venezuela, because right now that's not clear.
Is there a sense, would you say, that the Donroe Doctrine is fully enforced right now?
I think this is a variation. It does seem like the president believes he can do whatever he wants. For example, he wants Greenland. And he's going to find a way to do it, either via force or he insists he wants to buy. The problem is that this is not something that's going to benefit the country. Today, the president said that their plan is to be handling the oil business in Venezuela for years to come. The president has to leave office by 2029. The presidential election is in November 2028. This is not something that any other administration can continue. This is something that is creating an environment, not just because of the Venezuelan incursion or the pressure or bullying against Greenland, The problem is that we're alienating those who we need, not just to fight against drugs, to fight China and Russia.
Maria, great perspective there. Maria Puerta-Riera of Valencia College, thank you so much for your time today. Coming up, we'll discuss what's at stake in Greenland as President Trump turns his gaze back to the Arctic island. Australian miner Energy Transition Minerals will be weighing on the impact of its business. Keep it here with us. This is Bloomberg. Well, President Trump has leveled fresh criticism at NATO as tensions rise over a possible U.S. takeover of Greenland. Danish Prime Minister Mette Frederiksen has said Trump's push to acquire her nation's territory could spell the end of the military alliance. While Trump cast doubt on NATO via social media, European leaders issued a joint statement stressing that security in the Arctic must be achieved collectively by the allies. Our next guest runs an Australian miner with a rare earths project in Greenland. Shares of Energy Transition Minerals surged after the White House said President Trump wouldn't rule out the use of military force to acquire the Arctic island. Let's bring in the company's managing director, Daniel Mamadou. Daniel, good to have you with us. I mean, not everybody agrees. I've read several articles. Not everybody agrees that Greenland is actually a mining gem. Talk to us about the potential. Can you quantify what can be found there in terms of resources?
Well, Greenland is obviously a huge island. What I can speak for is definitely our own project, which is the largest rare earth project in terms of size and resources. We proved up in excess of 1 billion tons of mineral, and that was exploring of basically less than a fifth of the mining area or the license area for our project. And so that's essentially a strong foundation for a world-class asset that could last centuries, really.
Some suggest that it is commercially challenging to mine in Greenland. Is it more challenging than anywhere else?
No, absolutely not. And that's perhaps one perspective. But from our own side, what we've done is we've essentially done the relevant feasibility studies that have established that this project is extremely valuable, and that's the reason why we spent more than $150 million over the past decade, and we will continue to focus on the exploration and find a path to the development of this asset.
No secret that President Trump is interested in acquiring Greenland, and we had a guest today just talking about how she thinks Trump will do whatever it takes to acquire Greenland. What do you make of the prospects of the U.S. running Greenland?
Well, we are miners, we're not politicians, so I can't really have a view on that. From our perspective, really the focus is bringing this resource into the supply chain. We're a Western-aligned platform that brings critical minerals to the supply chain, to the rest of the world, and that's our focus.
As a big player in Greenland, have you been approached perhaps by the Trump administration or officials from the White House showing any interest in your company?
We continuously receive approaches, not just only from the White House, but also from other parties. That includes Europe, that includes China, that includes international investors. And
when was the latest approach from the White House or the U.S. administration?
So just as recently as last week. So,
might a Greenland that is managed by the U.S. bring benefits? I'm just wondering because a mining project of yours got shelved back in 2021 because of some concerns over uranium. Might the U.S. adopt a lighter touch when it comes to regulation over things like the environment?
I'm not too sure. When you look at environmental regulation in the West, including in the United States and in Greenland, the standards are very, very high. I think what is important to realize is that just because policy shifts, and in Greenland policy has shifted at times in favor as well as against our project, the strategic asset and its strategic nature remains. The asset lies there, it doesn't move. Right? And so projects of this type tend to have very long cycle, and generally markets tend to misprice long cycle optionality at the beginning until there's a shift in the situation, which is what we're facing right now.
What could be improved in Greenland for businesses like yours?
Well, first of all, the Act 20, which is basically a piece of legislation that has been arbitrarily put in place to stop our project and also to has a retroactive impact on licensing. And I think that should be kind of reformed in some shape or form, or flexibilized. We need to take into account the concerns of citizens, absolutely. Mm-hmm. But this is a project that has proven to be safe and has been recommended by the highest instances, not just at a global level, but also internal level in Greenland over the years, right? So we are facing a political blockage. We are blocked by politics, not by geology. Or safety.
Rare earths is such a huge issue across the world for governments, for companies as well. And given that China recently weaponized rare earths again, we've seen a surge in rare earth stocks, including yours. Do you get a sense that perhaps there's a bubble or there's froth in the rare earth stocks?
Absolutely not. I think what there is there is a repricing in the market, and what is happening is that the supply chains for critical minerals like rare earth are now not priced just only based on cost, but more importantly on security of supply. Okay, and what the West is realizing and taking steps towards now is the fact that the tough projects need to be funded. China has been doing that for quite a while now, and we are now realizing that we also need to kind of go and not just take into account what the costs are, but also the security of supply that comes with owning your own supply chain, having a project in a specific jurisdiction. And so everything is being repriced according to not just cost, but also jurisdiction, execution risk, and locale.
Yeah. Daniel, thank you so much for that.
Thank you.
Daniel Mamadou there with his take on developments in Greenland. Let's do a check on how markets are doing right now. Of course, trepidation on the back of what we had overnight, plans for Venezuela as well as oil. S&P futures shaping up to be, well, pointing to a negative open, currently down about 0.1%. So too are the rest of the benchmarks. Of course, Asia being caught in the concerns happening globally as well. Still ahead, Morningstar's Lorraine Tan weighs in on market sentiment and shares her outlook for the first quarter of 2026. And later, DBS Bank's Radhika discusses the outlook for Indian markets as US tariff negotiations remain stalled. More to come in our next hour of Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Asian stocks are struggling for traction today as investors largely stay on the sidelines ahead of Friday's U.S. payrolls data. Traders also weighing rising geopolitical uncertainty and a mixed global economic outlook with another earnings season approaching. Bloomberg's managing editor for Asia Equities, Lian Ting Tu, joins us for more on today's market moves. Lian Ting, I mean, just when you thought, traders will shrug off geopolitical concerns, now they're back being on edge. What's going on?
It's because of the intensity of those events, I guess. As you mentioned, the U.S. payroll, that will really set the tone for next week. And that will show how the jobs and inflation balance is playing out. And that will definitely have implication on Fed's decision going forward. And that, as you know, obviously having a global impact. And second thing is Supreme Court decision on Trump's tariffs. That's Friday night, our time. It's a very closely watched event, just because if the decision is that the tariffs are invalid, that could really cause some upside moves in many markets. So people are doing a lot of calculations on what could be potentially winners.
Fundamentally, there's still access liquidity.
Exactly.
Lots of money still sitting on the sidelines. This rally can go on.
Yes, I think that's the overall tone. If you look at the stock performance around the world, I think they are all up, all doing well. Of course, Asia's doing better. Korea's doing the best among all. But overall, yes, the dry powder is still very much there. People are looking at sort of different pockets within this big AI trade to allocate a little bit more. But also healthcare is also highlighted as another sector that could see potential upside in profit growth.
And of course, when it comes to tech, we're headed into the earnings season. Might that provide a further boost? What are the expectations out there?
Yeah, I think expectations are really, really high. If you look at Samsung today, the prelim was really good, right? Tripling profits, record profits, but shares were barely budging. I think, people have been upgrading or revising up the estimates just along the way quite rapidly in the last few days. So even though it's a blockbuster result, it was just in line to many people. So I think, TSMC is also coming up, right? People are also thinking, the result will also be good. And there is, of course, the U.S. tech giants that are going to report soon. The results, I think expectations are high. It's harder to meet. But again, if people think the profit growth is going to continue to be really high, that could continue to be a very good sector to be in.
And also valuation seems still reasonable when compared to the peers in the U.S.
Yes, for Asia, for sure. If you look at Kospi, I think it's about 10 times forward PE. It's really much lower than Nasdaq's 30 times.
And in the commodity space, of course, generally commodities are doing really well, precious metals in particular, gold. And oil is one we're watching on the back of developments to do with Trump. Trump wants oil at 50, and now they say traders want that to be lower. There's nothing special at 50, they say.
Oil, I think the global supply-demand picture is very much about supply glut, right? And Trump, of course, wants 50, but I think the supply will come from Venezuela. It takes a long time for the supply to actually come to the market. The infrastructure is still very dilapidated, and so it takes a few years. It's not going to overnight change the picture. I think overall, oil is really trading on the sentiment right now.
In terms of the overall theme, what would it be for the markets?
Yeah, and I think right now it's the bond market. If you look at corporate bond issuance, it's a record high for this year to date. We're looking at $260 billion. What does that mean? I think it just means really a lot of fresh powder sitting on the sidelines. And also, all these bonds are absorbed without providing much more new issue concession. That means investors are not very demanding. They're just buying the papers. But if you look at Japan, of course, slightly different picture.
That's right. JGB's in focus, the auction in particular. How's the response been for the JGBs?
Yeah, the response this time around today was particularly weaker than average, I should say, after a very good response that we saw in December. Part of it is also just because there is an expected surplus of, net supply of JGBs expected for this fiscal year. I think we're looking at the biggest net supply in over a decade. So there is a lot of paper for traders to digest. And of course, they're demanding higher yield. And if you look at a 10-year JGB yield, it's already at highest since 1999, and it's already higher than China's. So the implication is, Japanese government may have to actually adjust the spending plan. I know it's very ambitious, but if traders are not buying or they demand really high yield, things may have to change.
Lian Ting, thank you. Bloomberg's managing editor for Asia Equities, Lian Ting too. Now let's get perspective from Lorraine Tan, Director of Asia Equity Research at Morningstar. Lorraine, good to have you with us. Happy New Year, if you can still make that greeting. What's your take? Is still AI in play pretty much for 2026?
Yeah, hi, Happy New Year. I think so, because if you look at where where there's strong investment in terms to drive the whole sort of infrastructure for AI, and where people are spending, I think there's still room definitely for AI. And I think if you look specific to Asia, if you look at, for example, if I take China, a lot of the proportion of spending, proportion of budgets that have gone into AI-related spending is still relatively low compared to U.S. counterparts. And given government support and all that, I do expect this will remain one of the key drivers for this year. And the valuations, I think, yes, a little bit heated for some companies, but there are selective opportunities out there as well.
Will those AI plays do as well in 2026 as they did in 2025?
I think the whole thing with the Asian markets, or if I look at, primarily China, Hong Kong, for example, even Singapore, I think when we look at where valuations were at the beginning of 2025, end of 2024, they were a lot lower on a relative basis to our fair values, right? So now we're coming into markets that are closer to fair value. So I think in that sense, yes, you still have pockets of outperformance, but I think we have to be quite careful or quite selective in this sense, where we should expect a lot more rotational play. So, for example, and that pullback that we saw at the end of last year was actually very healthy. So that actually allowed some of the companies to come back into buy territories, and it gives an opportunity for us to pick those up again. So I do expect this sort of rotation to go on, and then obviously companies that outperform, if the outlook improves, that's going to be a consistent driver going forward.
What have you been picking up, and what do you hope to pick up? Which are the ones looking attractive?
In terms of AI, I think, and valuations, we still have a preference for Alibaba in this case, on the Hong Kong China side. TSMC, for example, is still a company, widely followed and attractive company that we like. And these two in particular, I think, are areas. There are smaller companies that we think will benefit as well, along with on some of the data center side. There are, I think, but I would tend to highlight companies which have upside to this at this point in time, and that's what we're looking at. But Alibaba, I would highlight because the fact that share price had been contained because of the fast delivery competition that was going on in China, that being a concern. But I think if we look at Alibaba down the road, 5 years down the road, we think the cloud services is what's going to drive its earnings growth.
Mm. Lorraine, we know that Morningstar emphasizes companies of quality, companies with sustainable competitive advantage for the long term. When you take into account that strategy, how do you factor in the shorter-term volatility, the mini crisis that we're bound to see? How do you square that?
Yeah, so we, as you mentioned, yes, we do look through the cycles. What we have to be careful, what we have to note is we will take, any pullback as an opportunity. If we feel that it doesn't impact the fundamentals of the company, the valuation is intact, we see that as an opportunity to buy. Obviously, for some investors who may have, more short-term leanings, it becomes, who don't want to hold things through the cycle, yes, you're obviously going to be trading a lot more. But our view is that we get the most upside to when you're able to hold through these downturns, and consistently, if you're disciplined and you think something is overly valued, to sell, because for expectations to continue to beat, or estimates to continue to beat expectations is actually quite difficult.
Traders continue to talk about that concentration risk, and case in point would be AI and tech. For those looking to diversify, what kind of strategies, how would you be diversifying?
Yeah, so we think the other two themes that we should watch out for is, we're still hoping for a stronger recovery in Chinese consumption. So this has been very slow. This has not necessarily been the primary focus for the government. But I think given recent rhetoric and recent numbers, we should start to hopefully expect to see some more supportive policies coming through. So we think that most of it, the consumption in China is probably bottomed. But what we're hoping to see is like retail spending go back to something that's more closer to our long-term expectation, which is around 5% growth. It's probably officially around 4% at the moment. So we're hoping that will actually drive a recovery in some of the really undervalued consumer plays. So that, this is the sector that's probably seeing most valuation upside at this point across the board. Even in Japan, because of the geopolitics, we saw a pullback in some of the consumer names there because of the concerns to the Chinese consumer. we also see that if you look through the longer term, we see the buying opportunities there as well. So that's one area that we would like to look at. Yum China is a name that we particularly like at this stage. We think that they will be able to grow their market share in the smaller tier cities, the lower tier cities as well. On the other flip side, the other theme is actually the interest rates. So dividend yielding stocks are doing very well this year. We think there are opportunities, not so much on the banks, but we do like some of the S REITs, for example, the Singapore REITs and other regional REITs that do have that upside potential, given that they're paying out, the distribution units are more than 5%. Asian bonds predominantly have come down a fair bit. So they, Asian bond yields have come down a fair bit. So some of these corporates are looking to be much better proxies for people looking for yield.
Lorraine, I just want to pick up on your thoughts on China. You talked about consumption, how it has probably bottomed and should be picking up. The thing is, it'll be quite a while before it gets to where it needs to be. At that, the property sector, which remains lackluster, perhaps still even in crisis. How are you assessing these factors as risks to your investment in China?
Yeah, so we think the real estate risk has diminished. The reason we say that is because obviously inventory is slowly being absorbed, excess inventory. And part of that is because supply has really not come out. So there's been much more reduction in supply, more absorption of inventory. That means we expect to see a stabilization in real estate prices over the course of 2026 into 2027. So I think that would actually really help with consumer confidence. The other part of it is obviously employment. So that tends to be, unemployment figures in China, youth unemployment is still historically relatively high compared to the recent, let's say, 15-year history. So we would probably want to see some stability or some improvement in that as well. But on a real estate front, we actually see that the risk there to be bottoming out, and that's actually also a positive.
You talked about how you're quite attracted to dividend plays. The likes of OCBC, DBS, Singapore banks, are they as attractive? They have been dividend plays for a while.
Yeah, and they're still really doing well on that front in terms of the share price performance. They're both yielding around 5% based on our forecast, based on recent share price. It's intrinsically, if you look at it, the earnings growth should start to taper off because margins will probably start to decline over the next few years. So we think the bulk of the dividend growth has actually diminished. Share buybacks are still possible because they're both very, well capitalized. But I think this is where we feel that a REIT like Keppel REIT is probably a better buy if you're looking for dividend performance. Keppel REIT's also yielding about 5.8%. We think the market is tighter for commercial office space in Singapore, and that's going to help drive rentals. And on this note, we think the earnings potential will be there. Earnings growth, distribution growth should be there for some of the Singapore REITs as well.
We've been talking on the show of the expectations of emerging markets and Asian markets as a whole doing well in 2026. That's your own expectation as well. Lorraine, I'm just wondering what could go wrong? What if the Fed cuts only once rather than twice? What if the dollar remains elevated or regains its strength? What are the risks you see to all the projections for the year that you've made?
Yeah, so obviously the Fed cutting less than anticipated, interest rates basically staying higher than expected is going to be one of the negatives because it's going to bring I think, overall valuations for some companies a bit lower. So we've got to watch out. This is where I think if things are overvalued, that's where it becomes dangerous. I think with the markets at the moment being fairly valued, I think that would probably lead to some rotation rather than a huge market crash. So because we don't have the financial sector stresses that we normally associate with larger market crashes. So I actually don't think financial stress will actually lead to market crash. It may lead to periodic pullbacks. given what the interest rate direction is. Our house view at the moment is because we do see the U.S. economic growth slowing. So we therefore do expect interest rates to normalize to about 2.4% in 2028. So we still do see a downtrend. So as long as that's the case, we actually are quite comfortable with our current valuations. The key risk to us is obviously something that you don't, obviously the geopolitics at the moment with what's going on with Venezuela, et cetera. I think that has ratcheted up the geopolitical risks again. And so we're going to be mindful. We have obviously, therefore, to prioritize or be very selective in the stocks that we like. So again, export sector plays out of China, things that are sensitive, that could be banned in the U.S.
Right.
We may not see the tariffs, but there could be more targeted restrictions.
Lorraine, thank you so much for sharing your strategy with us today. Lorraine Tan, Director of Asia Equity Research at Morningstar. Up next, shares of Chinese OpenAI Z.AI rising on debut in Hong Kong. We'll hear exclusively from the company's co-founder and chairman on what it means for the global AI race. This is Bloomberg. There goes the gong. Shares of Z.AI trading under the name Knowledge Atlas Technology. They're rising as the firm debuts in Hong Kong. The company is building large language models to rival OpenAI and Anthropic, and it's the first Chinese AI startup to go public. Well, earlier we spoke exclusively with Z.AI co-founder and chairman Liu Debing, who says U.S. developers may succumb to the same price-based competition that has forced Chinese AI companies to forego profits. He explained the reasoning behind taking the company public.
We've had some plans for going public since quite early on. Our R&D investments in foundation models and the following commercialization strategy were essentially preparations for an IPO. We started some initial work since last year. Now we achieved the IPO this year. That's more about following the natural progression of steps.
How do you plan to spend the money that you've raised through the IPO process? Where do you see it going mostly?
The fundraising amount for the IPO is planned based on the company's development strategy. There's two major segments: R&D for foundation models and the following commercialization strategy. 70% of the IPO funds will be allocated to R&D for foundation models, which includes the development of a universal foundation model, the currently highly anticipated intelligence agents, and multimodal systems. About 10% of the funds will be allocated to commercial infrastructure, supporting the foundation model. This includes developing inference tools and models as a service. Additionally, a portion of the funds will be allocated to ecosystem partnerships, and some funds will cover operational expenses or general corporate purposes.
As a company, Z.AI was initially more focused on government and SOEs, for instance. How do you see that changing, and are you looking to build out more partnerships in the private sector instead?
The demand from large B2B clients is substantial, which accounts for a relatively high proportion of our current revenue. But we're also seeing that our cloud-based revenue, specifically from our MaaS platform, is growing rapidly, where we saw user numbers grow tenfold. However, due to its lower pricing, its contribution to total sales revenue remains relatively small. We believe that in the future, sales of standardized products, particularly those based on MaaS platforms, should generate larger revenue and grow at a faster pace. We anticipate that growth will exceed 50% over the next 3 years, with more than half of that likely coming from cloud-based clients.
It's been said, for instance, that something that Anthropic might charge $200 for, Z.AI, for instance, would be looking at 200 yuan. So it's obviously priced a lot less than what you see in the US. But how does that impact your margins, and also how does that impact your path to profitability as a business?
We believe that based on the overall trend, the price for mass will continue to fall gradually, because we think it should be an infrastructure for the entire society. At the same time, for AI, for example, the compute costs should also be gradually decreasing. We see this trend very clearly. For instance, in our current coding plan, the price of compute power for our coding API is about 1/10 of cloud's, while our performance can reach 90%. This makes us more competitive and benefits more users.
Do you think then that US companies like OpenAI or Anthropic, do you think that they actually need to look at the pricing strategy of companies in China?
I believe that once the market matures through full competition, more people will understand the capabilities, performance, and pricing of these models. Reaching a state of equilibrium, it is possible for U.S. companies to lower prices, but ultimately, I think that depends on their own decisions.
I'm wondering also about the geopolitical angle, given that there's been a lot of discussion around H200 chips and the access of those in China. Would you be looking to acquire those? And which chips are you using as well from the domestic companies?
We maintain an open attitude regarding the use of chips, as we focus more on cost effectiveness. We hope that the chip performance will become even better, while the chip price will be lower, so as to reduce our overall costs.
Z.AI chairman and co-founder Liu Debing speaking to our Asia Tech correspondent Annabelle Drulers. Now, some top global stories we're following. Hong Kong's Financial Secretary Paul Chan has told local media that IPO fundraising for this year is likely to exceed 2025. That's as geopolitical tensions drive Chinese firms to list in the city over U.S. markets. Speaking with the Hong Kong Economic Times, Chan also said the risk of widespread defaults among small and medium-sized developers remains very slim. The alleged kingpin of an international scam syndicate has been arrested in Cambodia and deported to China for investigation. Both U.S. and UK authorities had sanctioned Chen Zhi over his alleged role in building a network of scam compounds in Cambodia run by enslaved labor. The U.S. last year alleged Chen ran a sprawling cyber fraud empire, seizing about $15 billion worth of Bitcoin. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. India's been trading for about 45 minutes. Here's a quick look at where markets stand right now. The Sensex under pressure along with the other benchmarks down for 4 days in a row. It is reflecting that sentiment in the broader market. The MSCI Asia-Pac Index currently down about 0.5%, dragged down by the likes of the Nikkei, the Topix, as well as the Nifty Index. The Sensex down 0.2%. Geopolitics pretty much in play, impacting sentiment of a developments on comments made by Trump on Venezuela as well as oil. This is how it's looking in terms of the Indian rupee trading 87.78 versus the USD. It is up by 0.2%. Of course, we've seen the rupee inching upwards, smashing that 90 level, pretty much being boosted by that help from the RBI. Now, President Trump says Indian Prime Minister Narendra Modi is unhappy with him over high U.S. tariffs. This comes as trade talks remain stalled. Let's bring in our India government reporter Sudhi Ranjan Sen. Sudhi, it does seem like there's been little progress.
Yes, I mean, the trade deal, so to say, is stalled, and when we speak to government officials, there is an effort and there is an intent as well to conclude this. And what we get to here is that negotiations are largely over. It's now up to the politicians on both sides. But as we have seen, repeatedly hopes of being able to strike this deal quickly. get down to business has not quite worked out. And that has caused a lot of heartburn in India, because this was one big trade deal that Prime Minister Modi was chasing. The relationship with the United States, one of the most important relationships that India pursues. And over the last 10 years, we have seen Prime Minister Modi, trying to bring India and the United States closer. Similarly, we have seen President Obama and other administrations, President Biden and President Trump in the last administration, have generally worked towards, strengthening and broadening and widening the relationship. But on the trade deal, things have looks to have broken down, kind of.
The thing is, we've seen mixed signals from Trump when it comes to this deal between the U.S. and India. And of course, despite the fact that he says that both sides are good friends.
Yes, and while the broader relationship, the defense relationship, the defense partnership between the two, we have seen the militaries continuing to, exercise. There are regular diplomatic contacts between the two sides. The U.S. ambassador to India is likely to take up charge in the next few days. So all those things are going on. But where it matters the most, that is the trade deal and getting everything back on track and on the rails, so to say, hasn't moved. And that was the big thing that India was expecting would happen quickly. That hasn't happened. And that's causing problems for Prime Minister Modi in India. And the repeated mentions of Prime Minister Modi by Trump is not doing much good to Modi's image internally as well.
We know that Trump made a mention of the Apache helicopters delivery. What do we know?
Well, I mean, the numbers that President Trump quoted about the number of helicopters that India had asked for is not what we have heard and not what we are hearing. India, bought around 30 odd helicopters, 22 odd for the Indian Air Force, 6 for the land forces. All those have been delivered from what we are getting to hear from the Defense Ministry and the others, those numbers don't match up. So unless and until there have been more talks, which doesn't seem to be the case, the numbers do not reflect the actual position.
Sudhi, thank you. Bloomberg India government reporter Sudhi Ranjan Sen there. Staying with India, we're seeing some support in the Indian rupee, and some traders are saying that India's RBI, the central bank, has sold dollars in the FX market to support the rupee. We've seen this in recent days. Of course, this is a currency that was the worst performing in Asia in the last 12 months, getting support from the RBI. Traders saying that the RBI sold dollars in the FX market to support the currency. Now, India says it expects growth of 7.4% in the current financial year through March. This would maintain the nation's status as the world's fastest growing major economy despite trade tensions with the U.S. Joining us now, Radhika, senior economist at DBS Bank. The number, well, pretty solid. 7.4 isn't too shabby, but it comes from an 8% growth in the first quarter.
Certainly, Haslinda, it's a very strong number. I think it was not far from where the street estimates were. Our own forecasts are a bit higher than that, in fact. We should remember that this number actually captures actual data till about November, December. So there's about at least a quarter more to go in the official numbers as well. This number assumes importance from a couple of angles. I think this is the first advance estimate. It's an initial feel of what the government thinks. It comes a month before the budget presentation. So what do we make of this number, and the budgetary ratios become important. This, of course, is the real growth rate. I think much of the market participants were looking at what the nominal number would be, and that's come at about 8%. So which tells you that from a growth perspective, budgetary ratios are not at risk. I don't want to go into the nitty-gritties. I think in terms of the rupee value, FY25 has done better than budgeted. So, FY26, you don't really need that much of a gain. So at 8%, I think numbers will look okay from a growth perspective. So certainly, to your point, I think 7.4% to my mind still has some upside risks.
So for the year, how might it look like for India?
So our own growth forecast is really on the firmer side of consensus. We are at about 7.7%. And I think it comes from a couple of things. It does come from a very clear shift in the playbook. I think there is a much more an impetus towards boosting domestic engines, consumption and investment particularly. The government is playing its part. In fact, in the past 6-8 months, you can actually see reforms being undertaken. I mean, labor reforms was one, which was a slow-moving engine, and you finally seen the light of day. Then you've got direct and indirect tax reforms as well. And from the central bank's point of view, they've lowered rates. Of course, not all of that has percolated through the market mechanism, but as an intention to ease financial conditions, that has been undertaken as well. And I think we are not seeing the end of it. We do think in the upcoming budget as well, the emphasis will be on the government supporting its new and strategic ambitions. And I think that's where the nitty-gritty will be.
And there is a need to support the domestic engines, given what's happening between the U.S. and India, that trade deal that's still stalling, exporters getting hit in a big way, in fact. I mean, how will that square? Is your estimate contingent on what happens with this trade deal?
Certainly, I think we have built in that cautious estimate in our FY27 forecast, which is the year that starts in April. So I do think that any upside from our current forecast will be based on how the trade deal goes. And I should also highlight here that the trade deal does have some exclusions. Not the trade deal, sorry, the tariffs has some exclusions, especially the well-performing electronics, the important pharma sector. All of these exports don't come under the tariff umbrella as yet. So while you have seen a 50% nominal tariff being raised, if you see the effective rate, it's lower than that. So yes, but labor-intensive industries are feeling the pressure. I think the government has undertaken some steps to provide relief. But yes, I think if the trade deal manages to bring down the nominal rate, that will certainly add a lot more. You'll have one more engine that's actually working in support of the economy, and growth could potentially be higher than where we see at this point.
The Indian rupee is feeling the pressure. If not for the RBI, it would be dwindling further. Is that a reflection of uncertainties to do with the trade deal or fundamentals?
To my mind, it's the rupee slippage that we have seen somewhere from about November, December, kind of has gained momentum from there, is a shift in the response mechanism. I think we are looking at a new equilibrium now based on more macro realities. The policymakers would prefer depreciating or rather competitive currency in the face of the delay in the trade tensions. Then you had, a bit of outflows as well from the equity market, for instance, last year. So balancing all of that, I think, is where what you see in the currency. Our own in-house estimate is for a bit more weakness in the currency going into fiscal 27. But everything is about not having, visiting those levels in a knee-jerk fashion. I think the policymakers have been very clear, as you've seen today as well, that when you see psychologically key levels step in, there
like
is certainly 90 has been one, and then you've got levels above that as well, which were visited earlier, to make the process very slow. And you don't want any speculative element in this entire trade. I think that's where the central bank is.
So do you expect the rupee to be pretty much range-bound because the RBI is there to support it if it weakens further?
Certainly, I think we do, in fact, expect a bit more weakness in the currency. So I would say that is a function of a few things. A function of, how the trade deal goes, the timing, and what the contents, the nuances of the trade deal are as and when it's announced. What happens to the broader dollar? I think we are looking at that as well. And cumulatively also on flows. India's current account is extremely manageable at present levels, right? You're going to see it at about 1% of GDP, very manageable. Fiscal deficit has been correcting. So it's not so much to do with macro realities. I think it's a function of a lot more exogenous factors that we are looking at this point. So again, as a base case, we are looking for a bit more weakness in the currency, but at psychologically key levels, you expect a very strong resistance.
Inflation has been benign as well. How will that factor into what the RBI does from here? How much scope is there for the RBI to cut rates?
Oh, inflation has been really a very good story this year. So when I say this year, I mean fiscal 26. It's been very, it's been sub 1% for 2 months. We also had indirect tax cuts that basically adds to the disinflationary pressure. Now going forward, numbers are going to go up. I think it's a trend that's bottoming out. But on the year, you're going to see inflation at about 2%. So that's at the lower end of the central bank's band. Looking forward, I think we are looking for a pick up in inflation to about 4%, 4.2%, not that much. But what the central bank is doing is, I think they've already taken preemptive measures. Inflation was low, it allowed them room. Growth was still very strong, but real rates buffer was sufficient. They've cut rates. As our base case, we don't expect them to do any more on the benchmark rate. But that doesn't stop them from making sure that the other, the bond yields at this point are elevated. Liquidity is behaving cognizant of what's happening on the seasonal drivers. They could continue to act on that. For example, they've done some bond sales. They've announced some FX swaps. So I think they're addressing different parts of dislocation with different, I would say, set of measures. But on the benchmark rate, we think the bulk of the rate cuts are behind us, so we don't anticipate any more.
This is against the backdrop of a Fed that is expected to cut, but there is a risk that it could be fewer cuts than the market's anticipating. How might this weigh into the RBI's considerations?
Yes, certainly. I think if you see the Asia as a whole, everybody's yields have kind of compressed, or the rates have compressed, the gap between where the US rates are and where the Asian rates are. Typically, you don't see that, right? EM rates tend to be at a good buffer in these rates. So insofar as the Fed is concerned, I think the RBI, the way they're going to look at it is Fed's move does matter, but it's a one part of their entire, I would say, dashboard. They're really looking at where inflation is, how much room is that giving them, how the currency is behaving, and how the entire economy is faring. And we were just talking about a 7% growth or a 6.5%, 7% growth. If that's the range, I think to justify a very aggressive rate cut cycle is going to be challenging. So yes, I think they will keep an eye on what the Fed does. What does that mean for the dollar? But I think insofar as the rate cut trajectory is concerned, I think it's a function of what domestic considerations are.
Is a rate hike totally out of the question? I mean, that is one move the RBI could take to support the currency.
Certainly, I think when the currency does face pressure, the markets tend to play out with what are the various things that is available in the policy toolkit to take action, rate hike being one of them. But if you listen to the central bank's commentary, if you look at the growth momentum, their forward-looking commentary, all of that seems to suggest, that they would be a bit more wary of hiking rates. I think that would be perhaps one of the measure of last resort, so to speak. At this point, I think intervention is helping, and like I mentioned at the very start, it is a shift in the response mechanism. If these two things do play up, insofar as the currency maintains market-based action, I don't think there is any urgency for them to hike rates at this point. So yeah, one of the, I would say, a measure of the last resort.
Geopolitics have become to the fore. We've started 2026 with a bang when it comes to geopolitical tensions. China has taken action to, dump its cheaper products in markets around this part of the world. How concerned is India about it? How is it impacting India's own growth?
Yeah, that's been a sticking point, I think, for quite a few years now, and where particular sectors where there seems to be more obvious signs of dumping or price-sensitive, competitive imports, the government has undertaken some countervailing measures or some countervailing duties. So I think it's been on case-to-case basis. I think there's also a broader understanding that India wants to jumpstart its manufacturing base, wants to be a bigger piece of the supply chain market. So if that being the case, I think the relationship with China would perhaps turn a bit more conducive than it is at this point. And I think they're looking at more participation, more cohesion, rather than just looking at it from a price competitiveness point of view. So that's where we are at this point.
7.4 growth is great, but India needs at least 8% to address the unemployment in the country. Realistically, what would it take for India to get there?
I think there will be a need for a supply as well as a demand side push. What you have seen in the past 4-5 years has been a very strong supply side orientation to policy. Infrastructure focus, wanting to make sure that the private sector is able to come out, particularly in some segments, electronic, EMS, as semiconductors, renewable energy, healthcare, all of these sectors, we've actually seen a bit more of momentum. I think there is, again, a shift towards now also considering demand side impetus, providing giving a bit more money in the hands of people by way of indirect or direct tax relaxation. So I think it's going to be a bit of both that's going to take. But dominant will be still supply chain. I think that is where employability, income generation, being able to absorb the amount of people that graduate every year will become very important. And I think you've really seen policy incentives, all of that really oriented towards that. But India will have to certainly move fast because you find yourself in a region where the competition is very strong. Many countries are coming out with incentives, fiscal policy push, come what may, to attract the displaced companies or displaced corporates who are looking to diversify. And keeping that ecosystem in place, India certainly needs to up the game.
Accelerate.
Absolutely. Accelerate the measures that they've already undertaken to make sure you're able to absorb all of that capacity.
Radhika, thank you so much for that. Radhika Rao, senior economist at DBS. Coming up, we'll hear from Infineon CEO Jochen Heinbach on how AI has become a growth story for the German semiconductor company. This is Bloomberg. Well, more from our coverage of CES. Infineon's CEO says AI now accounts for 10% of the group's revenue. Jochen Heinbach spoke with Bloomberg on his current priorities.
It's all about efficiencies, and we need to make sure that the power flow is not becoming the bottleneck for the race in terms of AI compute performance. And we are doing there very well. After tripling our revenue last year to the previous year, now we are targeting to double this revenue again this year, and this is capacity limited, not demand limited. So a really nice growth story across many products, many technologies, wide bandgap technologies, silicon technologies, modules, controllers, analog parts. So a great growth story for Infineon.
And then, which partners are you focusing on in particular for this as well? Because it's obviously a build-out that requires a very large ecosystem.
Yeah, absolutely. It's a very large ecosystem. And you have many of the key players, of course, here in California, but also elsewhere in the world. In Taiwan, we have key players taking care of power supply units, battery backup units. But, of course, it matters a lot for us to engage here with the hyperscalers and the GPU makers.
So you're talking about that expectation around revenue. I think you're looking at it to grow by more than maybe 100% this fiscal year or this financial year. But in terms of the overall revenue mix or the contribution that AI makes, how much more do you see it being a part of the business?
Yeah, it grows now to 10% of the group's revenue, so it really becomes relevant. It becomes visible in our top line and bottom line numbers. And I think the 10% is not the last statement. I think for the future, we will enjoy more growth because the power semiconductor bill of material in a rack is growing strongly. If you have, like in the current generation, $15,000 of power semiconductors per rack, that number will go up all the way to $100,000 per rack in 2030. So besides the number of racks, besides all the capital that is invested, we are enjoying a specific growth driver because much of the increased compute performance comes out of the fact that more power is delivered into the processors.
Mm-hmm. Automotives is still a large part of the business, though.
Absolutely.
Yeah, and this has been a market that's had quite a few headwinds as well. What does that look like for you for this year?
Yeah, it has puts and takes. On the one hand, the e-mobility is clearly in a slow-growing phase. In the US, the market is very slow. In China, also things are tapering off in terms of volume. There's price competition. In Europe, there's some growth, but we can make use of the capacities which we have, which we were used to apply for electric vehicles and dedicate them to AI.
Infineon CEO Johan Hannebeck speaking with Bloomberg's own Annabelle Drulis at CES. Now, here are some more top corporate stories we're following. AI startup Anthropic is set to be raising a new round of funding that would value the company at $350 billion. Sources say the Claude chatbot developer seeks to raise $10 billion in the current round. We're told Singapore's Sovereign Wealth Fund and Kochu Management plan to lead the financing, with Microsoft and Nvidia also expected to participate. Warner Brothers Discovery has rejected the latest takeover offer from Paramount's Skydance, encouraging shareholders to stick with the Netflix deal. Warner's board says it doubts Paramount can close the deal, which carries significant risks. Billionaire Larry Ellison has said he would personally guarantee $40 billion in equity financing for Paramount's hostile bid. JP Morgan has reached a deal to take over the Apple credit card from Goldman Sachs. In a joint release, Apple and JP Morgan say the transition should happen over the next 2 years. In a separate announcement, Goldman says the deal will give a boost to its fourth quarter earnings. And before we go, here's a look at tomorrow's show. Natix's CIB joins us to discuss Asia's M&A outlook as investors navigate geopolitical spat between China and Japan. And from our Indian Chief Economic Advisor, Arvind Subramanian, will be weighing in on U.S. trade ties as tariff talks between Washington and New Delhi stall. That is it for Insight. This is Bloomberg.